Good evening, everyone, and thanks a lot for joining for this webinar. Really appreciate your time. And as Umang was mentioning, in this note, what we are trying to discuss about is one of the approach that, the key approach you have for, on the pricing power side, and we call it buying nuggets of gold. I thought I'll just take you through the entire note and, quickly we will summarize the key thesis of this, and then we will have a quick 5 minutes on our views on the macro, the performance of all the funds, and then we'll put it open for Q&A. uh, so uh, the key point we are trying to say is that if you look at the markets, I think there are many confluence of factors both globally and domestically, which makes us believe that the market over the next 2 3 years would be difficult. Now, some of these confluence of factors is, first, if you think globally, like say the globalization. Now, globalization was a key enabler for economic growth and even the markets over the last 30 40 years. While you're not very clear whether it has come, it's reversing, but one thing is very clear that the benefits you're having from it is now on a declining stage, and which could be like the best case, and the worst case could be that things could be reversing there. Similarly, we've had a period of 30 40 years where interest rates have been benign. That's because inflation has been low because of the benefits of globalization to some extent. That also is reversing. The third is the whole disruption phase, where unless a company has significant moats, multiple moats, it's always vulnerable, and you are probably seeing some of these companies. I hope the note is visible. Uh,
Yes, it is.
Yes. So, even that is a key risk. And other than that, you come down to on the domestic side again. One is that we are seeing continued high valuations now. Not only the Nifty, obviously Nifty itself is some 15 20% higher than the long-term averages. But when you look at, say, the mid cap and small cap, they continue to be 1.5 or even two standard deviation away from their long-term means. The other being the earnings continues to be tepid, and we are sitting on a base of a multi-year broad-based bull rally, which typically, your return expectations from there should moderate, not like you should not behave the same way in this phase as how you have behaved in the last 3 4 years, because the last 3 4 years is it's not something which is going to repeat in the next 2 3 years to our mind. And having the same strategy or the same style would put you into a lot of risk, because the key thing in stock market or investing is capital preservation. And I think this is the phase. This is something we've been talking about for a couple of quarters now. That market, when you look at it from a 2 3 year perspective, is more about capital preservation and making sure that the returns that you have made over the last few years is something that you can preserve. And you think in terms of return more like how you will compound it over 3 4 years versus continuing to have a more or risk on kind of a perspective. So how is, in this kind of a framework, our investing style different? So as you would have known, our investing style is more about finding pricing power plays, and there are 5 ways by which we think we are different. We have tried to in this note kind of cover that. One is the mindset, which is we believe that investing should bring in simplicity in this complexity. The other is the process, where the focus is on the most important variable, which is the pricing power to our mind. Third is approach. Ours is not a strategy where we try to do treasure hunt, or we are going through something like which is more like a mining. We are more about picking up nuggets of gold which is visible in plain sight. Fourth being risk positioning. Our focus is on capital protection. And fifth, behavior, where we are saying conviction cannot be borrowed, and so on. So let's start with the first point, which is the mindset, which is simplicity in complexity. So if you look, if you are trying to truly benefit from the magic of compounding, then the company you should be able to look on a 5 year, 10 year basis. And for that, then you have to have what we call is the longevity of growth, which is here. And our belief is that when you find companies with pricing power, that determines longevity of growth for a company. And so finding companies with pricing power is a key advantage if what you're trying to do is find companies with longevity of growth. So our mindset is more infinite. We don't have like finish lines, and the idea is that we think more in terms of long-term growth. Uh, then what we did is very simple. Like, if the objective is to do long-term compounding, then, one of the ways to look about investing is do something, which is different from what would impede compounding. So to our mind, what impedes compounding in today's environment, first is a shorter term view, which is next quarter, or a narrower perspective of looking at 6 months, 1 year. And versus, we believe that if you are wanting to benefit from compounding, you should be thinking in terms of the next decade. So a lot of time gets wasted in trying to think what will happen to earnings, what will happen to something in the next quarter, what will happen to businesses, what will happen to margins in the very next quarter or 6 months. But we believe very little thought is gone on, spent on thinking really next decade, and then having a view on that. The second being the stock price movements. A lot of time the discussions revolve only around stock price movements and the business fundamentals. What we mean by business fundamentals here is the intrinsic value of a company. The lesser focus is there. To give you an example, for the last 6 months to 9 months, where one of our largest holding was HDFC Bank, and at one time we had almost 15%. As we speak, it's more like 12%. And one of the most common questions used to be, HDFC Bank has done nothing in the last 3, 4 years. Why are you holding it? And so the two things had nothing in common. Like how a stock is done in last 2, 3 years, performance wise, stock performance wise, has not much to do with the intrinsic value of the company. Even if we have a company where the 1 year growth outlook is not so strong because either they are merging or they have done some restructuring, or the sector is it's just 4 quarter earning. The intrinsic value of a company is based on, what the company will do over 20, 30 years. So the intrinsic value doesn't become less just because the next 1 year, the growth outlook continues to be weak. Though for momentum investing, it's critical, but when you are looking at long-term compounding, this is an advantage. The third being action versus thinking. There is a lot of this about action, about anything looking bad, you sell off, buy, and typically we're having very high churn ratios. But unless the focus is on thinking, unless the focus is more long term, compounding is not possible. Fourth point being comfort of crowd. Everyone wants to be around where everyone thinks is right. You don't want to do something which is more like independent thinking. The asset gathering versus alpha, and the relative performance versus absolute. End of the day, investing should be more absolute rather than purely relative to our mind. This is some of the data which shows how, when you look on a 1 year basis, like any other criteria, any other factor, quality also outperforms only like 15% odd time. But as the 1 year goes into 5 year, all other factors starts coming down and quality outperforms on a 75% basis. So if you look at this gray segment, which is 15 to 20% return, most of on a 5 year basis, 75% of the time you are in this zone. Same for the Nifty 200 index. And the chart below just shows how on a 20-year basis, a quality focused fund would have done 21x versus 12x for a value or a normal fund. Again, quality outperforms not only in in India or something. It does that globally, and across factors, it's one of the best outperformers. And the biggest outperformance for quality comes under periods of underperformance, because that's where they do significantly better. Uh, so now coming to the process, as to how we think our process distinguishes us. So we think that the single, if you go by the Warren Buffett saying, where he says that the single most important decision in evaluating a business is pricing power. If you have the power to raise prices without losing business to competitor, you have got good business. So our idea is to buy companies which have pricing power. So they are either visible in cost advantage, or they are visible in price advantage. In the very rarest of rare case, you find one or two company, which sometimes have both, or there is a period of time like 1, 2 year or 3 years where a company has advantage on both side, cost side and the selling or the willingness to pay side. To give you example of the second one, like Interglobe. So just because the competition is not so strong right now, they don't have enough supply. What is happening is that they are not even Interglobe being a low cost carrier is not only able to price almost similar to full service carrier, at the same time their cost advantage is significant versus them. So what are the key advantages of having pricing power companies? The key advantages is that pricing power companies are able to maintain their margins in an environment of high inflation that we talked of, or in an environment where market is moving from a broad base to concentrated. These are companies which are able to not only pass on the price increase or whatever impact they've had, at the same time their demand does not see an impact. Uh, Similarly, companies with pricing power are consistent compounders. Their margins, remain very steady and keep improving. So that sometimes acts as a second lever of growth, because people normally think in terms of volume growth, value growth, and the leverage. The margin impact is something which comes in once the company has pricing power. The third point being, such companies are very have low volatility. They typically market, once they recognize that these companies have pricing power, they in fact get premium valuations also. So these are the advantages of having pricing power companies, and the fact that their pricing power means they have a very high longevity of growth. So what is it that we when we say our process is pricing power, what is it that we are trying to do? So I could summarize it in these 2 points. One is we look for companies which have dominant franchises. So dominant franchises need not necessarily mean a pure duopoly or oligopoly. Industry wide, like say if you take the case of an Eicher would have say 4.5, 5% market share in the overall two-wheeler segment. But if you look for motorcycles above 350 cc, they would have almost 86, 80, almost 90% market share. So we want companies which have dominant market franchise in the segment that they are playing in. And what is it that we actually try to do in this pricing power? I think this line explains everything. So we say that it's the advantage in a key consumer variable which has very high variance. So each word here, is very critical. So to give you an example, say tomorrow, if you want to choose on which hospital you will go, then there can be many criteria for choosing a hospital. But the most primary one for you, I would guess, is that who's the doctor, which are the top doctors there. Is the hospital, like having all the modern facilities, all the modern equipments, and so on. And the third is the location. Now this could vary in different industries. So if you're in the airline industry, you would say, I want to move from point A to B. I want someone with a very high network and who's very punctual, and I want it at the lowest cost possible. And then many of the other things may be less weightage on how when you decide on which aircraft to which airline to choose from. So what we look for is that when we find that in the industry, consumer has two three variables which he weighs very highly, and then there is a very high variance in that. What we mean by variance is that if you say, I want a hospital with the best doctors, and there is like out of 10 doctors there's a huge variance. That is, many hospitals don't have those doctors, and there's only one or two which has it. Or say in an airline industry where most of the airline are not able to meet their not able to offer the connectivity network advantage, or not able to meet the timelines, or are very cost not able to be the lowest cost aircraft carrier. So what happens in those is that these companies have a huge advantage in a variable which is very important for consumer. When there is huge variance and there are a lot of weak people, but there are one or two who are very very strong, that's the kind of a setup in which companies you find typically having pricing power. And then we put them through some of the other filters, like we want quality first. We are not so backward index. I mean, we think investing is more forward looking. So instead of focusing too much on a static quality, our focus is more on a forward looking quality. I'll try and explain you what I mean here. When you say static quality, there is a lot of rigidity and dogma involved here. So a lot of the negative connotations which goes with quality investing goes with this rigidity and dogma. And by moving away from that, and the moment you say is that, for me, the fact that will this company become stronger and be more higher quality in next 3 to 5 years is more important then what we are looking on a backward basis is something that we focus on. And when you have a combination of all these factors, that the some of the points we mentioned, also management who play the long game, who think in 5-10 year basis, not like trying to game the next quarter, that's when you have pricing power. And when you buy, say, a portfolio of 20-22 companies with pricing power, is when the Lollapalooza effect happens. And that's what Charlie Munger says when he says that the Lollapalooza effect in business is about getting multiple mutually reinforcing factors, right? So this is what happens when you have these multiple mutually reinforcing factors coming together, is when you see pricing power come in. And then the next point, portfolios based on pricing power stocks outperform globally. So if you look globally, there's been enough data done here, enough analysis done here. The one I've quoted here is from a Bloomberg research paper where they carried out a 20-year research and showed how, this is the actual index which is there. If you go to Bloomberg, you'll find it. It's called BPP US, which is Bloomberg Pricing Power Index of US. And they've kind of seen how on a 20-year basis this style outperforms all other styles, and this is the style which gives you the lowest volatility and lowest drawdowns also in a bad market. So that's how powerful pricing power concept is. And now within that, how are we different, in the pricing power side, or how are we different on a quality perspective? What we aim for is not only established pricing power companies. So when you say pricing power, typically the connotation is that you will buy a Nestle, or you'll buy a Titan, or you'll buy one of these plays which people know is a established pricing power play. But we think the equal opportunities there in buying what we call emerging pricing power, or hidden pricing power companies, or companies which is misunderstood. And ours is typically we look to have a portfolio of 20-25 stocks, which would be a combination of these three things. And we drill it through our investment framework, where we put 30% weight on qualitative, quantitative factors and 70% weight on qualitative framework. And that's when they pass through this, is when we find companies where we think the pricing power is there. And how is our approach different? The nuggets of gold we talked to, there are two ways you can do investing. So Warren Buffett again has this line where he says, our investment approach is not that of a placer mining, the process of shifting through piles of sand for specks of gold. Instead, we attempt to apply our pricing power framework to find large, unrecognized nuggets of gold that sometimes lie in plain sight on the ground. So this is our approach. Like most of the stocks that we have bought or have, a lot of people tell us, "Arey, this so we could have also figured," and this was visible to us also. Like say, the HDFC buying around 14-1500, or say an HDFC Life when it didn't do well for 2-3 years at 580, or say Zomato or Eternal when there was a lot of misconceptions around the stock. So a lot of these things are actually nuggets of gold lying in plain sight. This is what we kept as the the heading for the note, because we think this kind of a sums up everything that we do differently. So this is more this than this. And some of the examples, if I give you as to where we find nuggets of gold. So if you look, there are many non-glamorous steady compounders. Like if you look at a Crystal or a Blue Star or a Ultratech, you don't think of them as pricing power. But on the over the years, if you look at what kind of compounding they've done, you will realize that they are non-glamorous pricing power plays. Then there are some hidden pricing power plays that you don't think of HDFC, AMC, or a KFin Tech as a pricing power play. But if you go deeper down, you realize that because of their scale, because of the uniqueness, they have significant pricing power in different aspects, which they may not have unleashed till now, but at an appropriate time they can be in a position to unleash. Then of course the established pricing power plays like say an Eicher or an Abbott, or when we say fallen angels here, we mean companies which at different times may have been a fallen angel, like Bharti 3-4 years back, or ICICI Bank 6-7 years back, and so on. Then the high longevity consumer brands like say a Titan or a Nestle, and then many misunderstood companies like Eternal, PV Fintech, Carborundum Universal. People don't think of them as pricing power, as I said, but they are pricing power plays. And then more importantly, what is the risk positioning we have? So Howard Mark has this, which I discussed in one of our prior note, where he says that, you cannot aim for maximization of return or minimization of capital loss at the same time. You have to have a balance in between. So we believe in having a balance where we think we are always ready for a black swan event, and we don't go on excesses on either side, like so that we are neither in a risk off phase where we are taking too much caution, nor are we in a phase where we are taking such risk that one bad event or something going wrong can negate all your returns. And this is explained in this the two graphs that do exhibits I have. So one of the ways, if you take risk on, is to manage money, like assuming that you are chasing glory of a rising star, like shooting star. So this kind of a thing is typically that you see often where people try to do that, where they try to take very high risk. The assumption being that in next 1 2 years you want to be the best, and we have seen many companies. If you look at the BFSI sector, there have been so many banks which have taken this approach, and while they have had 2 3 4 years good years, but the end of this is always the same, which is you end up looking 50 60% plus. And sometimes some of these banks then never come back, or same for other sectors and so on. So this is not what we aim to do. We are not running a sprint, we are running a marathon, and our focus is to have the magic of compounding. So this is where we differ on the point 4, which is risk positioning. Now, coming to the behavioral side, we believe that conviction cannot be borrowed, and this is what differentiates our approach. There's a very interesting line by Joel Greenblatt where he says that choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. So our approach when we say is pricing power, makes it very clear as to what we are looking, what are the behavioral and the institutional imperatives that we are trying to avoid, and that helps us in navigating this space. And there are some of the case studies which I will we talked about in a bit. I'll skip in the interest of time, so that we have enough time for Q&A. Also, I will now briefly summarize our entire discussion before I give it to Trilok for the macro and little bit on the fund performance for the last month. So the key point number one is that decadal macro trends which were conducive for economic growth and equities such as globalization, benign interest rates now seem to be at risk. Indian markets again are beset by confluence of factors such as persistent high valuation, tepid earnings growth, the base of a multi-year broad-based bull rally, which signals a challenging environment for the Indian markets in the medium term. The second being, during such challenging periods, invariably a shift happens towards timeless investing principles and disciplined long-term investing style. We believe the ACCPV investing style, our investing style, is based on long-term timeless investing principles of quality, business ownership mindset, and capital preservation. And this is what will hold well in the next 2 3 years. We discussed the 5 key points which differentiates us, the risk tolerance, how that differentiates us. That is, we are looking to run a marathon and benefit from magic of compounding rather than being a shooting star. And since pricing power is such a, so this is one question which comes in, good that it's there in summary, we didn't discuss it. One of the question which comes is that if pricing power is strong and everyone knows it, how is it not priced in? Where does it leave any upside? So this is again from a research paper where it says that since pricing power is such a pervasive concept, there are good reasons to expect that it has already been priced in by the market and does not offer consistent outperformance opportunity. However, companies with strong pricing power have historically earned consistently strong returns while maintaining a lower risk profile. So this is also a fact. Like, you can argue that, why is Apple available at what it is, or why is Microsoft available what it is, and how despite such pricing power, they are not priced in immediately. But market continues to give you these opportunities, and that's the advantage. And this advantage we see is across markets, across market cap, and that's what we aim to do at Ambit Price Asset Management. We try to look for building a portfolio of 20 25 companies where we think we can leverage on this. So with this, I'll conclude my presentation on the nuggets of gold note that we had.
Hi, we will take you through our portfolio performance and how the portfolio have fared in the last month. Beginning with Coffee Can, our portfolio delivered, in line with the benchmark. Our top three performers for the portfolio for the month was Concord Biotech, Trent, and Bajaj Auto. However, KFin, Kotak, and Avenue sort of fell compared to the indices last month. Moving on to our other portfolio, Good and Clean. Good and Clean, Supreme, IGI, and Trend were the top gainers for the month gone by. Blue Star, Phoenix, and Balkrishna sort of, lost some sheen, particularly with respect to the unseasonal rains in the country. In an emerging in the emerging giant portfolio, we see CCL products being the star performer for the month, up nearly 50%. Prudent, the capital market proxy as well as Techno Electric, delivering very handsome returns for the month gone by. The losers were Sonata, Rajratan, and Orient Electric because of sectoral shift in the market. Moving on to 10x portfolio, CCL, Prudent, and Venus Pipes are the three names that delivered exceptional return for the month gone by. However, Orchid suffered because of poor results and some news that obviously impacted portfolio. Also, Lupin and Vector Foods was a dragger for the month that went by. So moving on to micro marvels, our best performers were Sharda Cropchem, Mayur Unicutters, and Insecticide, delivering handsome returns for the month gone by. The overall portfolio obviously delivered exceptional returns, beating the benchmark by nearly 100%. Whereas the stocks that did not do as well was Ice Make, Intero, as well as Eveready. On that note, I'll move to the next session. I will quickly take you through what are reading on the economy and what's the development happening across. So first thing first, in the on the domestic side, I think so. The good news is that GDP obviously beat all expectations. We grew by 7.5% nearly in this quarter versus the consensus 6.9%. And so the real driver for the growth in our understanding was a better GBA because of usually when the low subsidy payout happen is when the GBA sort of does better than on a YY basis. So if you look at the broader perspective, the GDP has sort of done in line or better than market expectation for last 4 quarters now. And exports has also been quite reasonably if you think about what's led to a good GDP for the Q4 that went through. When we move to next slide, when we will see the earning growth is also in line or marginally better than what most people anticipated. In fact, the earning is now 3% for the quarter. If you went at the beginning of the quarter, the expectation was at best 3 to 4% as well. But the revenue growth at 7% is similar to what we posted in the last quarter, and why the growth has been stagnant. The good news here is despite the inflation at a 3% number, the pricing at 7% growth, is led by primarily volumes and less pricing for most of the corporate, which is a good news that we have seen on the Nifty front. And the mid and small cap obviously have done a better number in the quarter that went by, reporting nearly 18 to 20% growth on a YY basis. The growth is primarily driven by, banks, metals, and telecom. Exponential growth by Bharti that we own obviously in Coffee Can portfolio, and banks obviously selective banks is obviously well exposed to in all the portfolios that we sort of are invested at. Moving ahead from the what's happening around to now, what's been the growth driver as I was speaking to. The full year number also from a growth is obviously a positive surprise both by the RBI as well as IMF. And growth particularly is driven by exports. If you think about on a financial year YY basis, electronics, engineering, and drugs are the key drivers from a growth contribution point of view. And thanks to the correction in the crude prices, petroleum products has obviously seen a sharp sort of fall in value terms, because that's what we eventually look at. And YY optically, the valued products have seen a downfall on an export front. What is more interesting is within the engineering goods, because electronic goods, I think most of us are are very well aware about the kind of products that India exports, particularly from an Apple point of view. But engineering good, I think so aircraft, electronic machinery, and motor cars is driving the growth, which is exponentially which proves the engineering prowess of the country. And our understanding is the degrowth in the metal and base metal commodities is essentially a function of prices and nothing to do with what kind of capabilities that the India brings on board. Last but not least on the chart, which is very critical to highlight, is the most of the gold prices rally that you have seen is driven by the hoarding of the gold by most central bankers, whether it's China, Russia, India, or any other markets that you see globally. Moving ahead, I think so. Moving to next slide, this is also an important point to think through. The capex in the country has been remained between 3 to 3.5% in the last 3.5 years as a percent of GDP. But more importantly, what are the R&D spends that we have seen? Has very critical component in the country. This is a recent report by RBI which suggests that every percentage increase in R&D spending has led to 0.2 to 0.25 percentage increase in productivity growth, and they have mapped this across the world, whether it's India, China, US, or anywhere else. The productivity growth in the US market is point every 1% lead to 0.5 0.56% sort of higher spending in terms of productivity. But India is obviously at above the trend line, and if you look at other markets, whereas particularly the commodity dependent markets, South Africa, Brazil, some of the markets that we see on the graph, they have actually not seen any meaningful sort of meaningful sort of benefit of higher so R&D spends productivity. So that is an interesting chart we thought we should obviously highlight. And more importantly, capex in terms of in terms of intellectual, or let's say intangible assets, will essentially leads to meaningful high productivity going forward, which is what the focus also is there across the private industry, unlike a private public capex, which is more focused on creating hard assets in the country. On that note, I will just move to next slide, which talks about the valuations, which is in line with long-term averages, nothing very exceptional. Post the recent rally, we are now marginally, margin premium above long-term averages. For our, understanding, the growth in FY26 in Nifty will be again, low double digit on a base of weak 6 7% on FY25. However, the ROE and the balance sheet are in significantly better shape compared to the last decade, which is why we think the multiples could sustain both from a long-term averages and compared to emerging markets as well.